Over 3 years ago, I was sold on a dream, one that promised I could become my own bank, enjoy tax free growth, and take loans out of my life insurance policy without ever having to pay them back. It sounded like the ultimate financial hack, so I bought into it. I purchased an index universal life insurance policy for myself, my wife, and my 3 kids at the time. I was fully convinced that it was the key to achieving everything that I'd been promised, everything that I was actually looking for in a financial solution. But after a little over a year of owning that policy, reality hit me very hard. The performance was nowhere near what I had been led to believe. The illustration I'd been shown when I bought the policy painted a very pretty picture, but the in-force illustration after just 15 months looked completely different. There were so many moving parts, hidden fees, and unpredictable factors that I realized I had made a very costly mistake. I decided to dig a little deeper. I revisited the books that had inspired me to purchase the policy in the first place, books that IUL agents use to push IUL policies, such as The Family Bank Strategy by David T. Phillips, What Would the Rockefellers Do by Garrett B. Gunderson, and Money, Wealth, and Life Insurance by Jake Thompson. And you know what I discovered? None of the strategies in these books involved index universal life. The families and businesses they reference built their wealth using whole life insurance, not IULs. I then started talking to many others who had either purchased IULs or agents who sold IULs, and that's when I realized that I wasn't alone. Many people, just like me, were being misled by flashy marketing and overpromising agents. I made it my mission to truly understand these policies, not just for myself, but so I could educate other people and prevent them from falling into the same type of trap. In today's video, I'm going to share everything I've learned about the inner workings of IULs. Whether you're considering buying one, you already own one, or are an agent looking to better understand these products and better serve your clients, this video is for you. I'm going to break down the promises versus the reality, the potential pitfalls, and why understanding these products is crucial before making any long term financial decisions. Stick around because this knowledge could save you from making a costly mistake. Many people who buy IULs don't fully grasp what they're getting into, and honestly, it's not even their fault. The reality is that most agents selling these policies don't fully understand them either. They often just parrot the same talking points that they've heard from their recruiters or their leadership. Become your own bank, tax free growth, retire with tax free income, take out loans without ever repaying them, and earn compound interest with zero market risk. These selling points sound very good, but they only tell you half the story. Yes, these benefits are possible, but index universal life insurance is rarely the best tool to achieve them. If you're looking to use life insurance as part of a long term financial strategy, whether that's for infinite banking, recapturing debt, creating a family bank, or supplementing your retirement income, you need to ask yourself 5 critical questions before you commit. One, is the cash value in my policy guaranteed to grow year after year? Two, is my death benefit guaranteed to remain intact as long as I pay my premiums? Three, will I have access to the cash value throughout the entire lifetime of the policy? Four, will the cost of insurance increase as I get older? And five, can I trust that my policy will perform as expected or close to as expected over the long term? These are foundational questions you should be asking yourself and your agent, or answering if you are an agent, before you even think about making a purchase. Today, we're going to dig into the 5 biggest risks of IULs that every client and agent should be aware of when planning long term financial strategies using life insurance. But before we dive into those risks, let's take a quick step back to understand how universal life products have evolved over the years. Before 1979, whole life insurance dominated the market. It offered permanent coverage with fixed premiums and guaranteed death benefit. It featured a cash value component that accumulated over time, which policyholders could access through loans and withdrawals. Whole life policies provided stability and predictability, making them popular for long term financial security and wealth accumulation. However, they lack flexibility in premium payments and death benefit adjustments, which became a drawback as economic conditions changed. Rising inflation and interest rates in the 1970s eroded the value of fixed rate products, prompting consumers to seek alternatives that offered higher returns and more control. In response to the economic challenges of the 1970s, E.F. Hutton and Company introduced the first ever universal life policy in 1979, marking the first new life insurance product in over 100 years. Universal Life provided a flexible solution to address consumer demand for higher returns and adaptability. Unlike whole life, UL offered flexible premiums, allowing policyholders to adjust payments provided there was enough cash value in the policy to cover the policy charge. Interest was credited based on market rates, offering the potential for higher returns with a guaranteed floor, and the death benefit could be increased or decreased based on changing needs. In the 1980s, as the stock market surged, consumers saw opportunities to benefit from the market growth. Variable universal life insurance was introduced in 1986 to meet this demand. Variable universal life combined the flexibility of regular universal life with the ability to invest in sub accounts similar to mutual funds, including stocks, bonds, and other financial instruments. The cash value's performance was directly tied to the performance of these sub accounts, allowing for potentially higher returns but with increased risks. If the market declines, cash value can be wiped out, making it difficult to cover policy charges, potentially leading to policy lapse. Now, in 1997, IULs were introduced in the market as a middle ground between traditional universal life and variable universal life. It offered the potential for market linked growth with downside protection. Since 2009, IULs have become popular as a permanent life insurance option. However, they are not as permanent as often advertised. IULs can lapse if not managed carefully, and their complexity can lead to misunderstandings and unrealistic expectations. Deceptive marketing and false promises often hide the reality that these products require ongoing management and regular premium adjustments to ensure that they meet the long term financial goals. Understanding the history and nuances of these products is crucial for making informed decisions about life insurance options that align with your financial objectives. As these complex products gain popularity, concerns about misleading sales practices and deviations from NAIC guidelines began to surface, putting both consumers and the industry as a whole at risk. Which leads me to IUL risk number one: the potential lawsuits and circumventions of NAIC guidelines. Since 2010, Index Universal Life Insurance has been at the center of numerous lawsuits due to the issues of misrepresentation, hidden risks, and undisclosed fees. Many policyholders purchase IULs expecting benefits like tax free growth and the ability to take out loans without repayment, only to find out later that their policies were not performing as promised. For example, Nationwide and other big insurers faced legal challenges because agents were using misleading projections to sell IULs, exaggerating potential returns while downplaying risks and future costs. According to the Wall Street Journal, these policies were marketed with unrealistic illustrations, attracting consumers with promises of market participation and downside protection, but failing to disclose the significant financial risks. One of the largest cases involved Transamerica, which faced multiple lawsuits over its handling of universal life insurance policies. In 2015, they raised the cost of insurance by up to 38% for around 70,000 policyholders, leading to a $195 million settlement in 2018. Many of these policies had been sold when interest rates were high, guaranteeing returns of 5.5% or more, which made the sudden increase in costs shocking for many clients. In 2020, another $88 million settlement was reached for similar issues, compensating policyholders with account credits or cash payments. Due to these widespread concerns, the National Association of Insurance Commissioners, NAIC, introduced new rules to create consistent standards for how IUL performance is illustrated. These rules, known as AG 49, AG 49A, and AG 49B, aim to prevent insurers from showing overly optimistic returns. In 2015, AG 49 was introduced to standardize how insurers project IUL performance. It limited illustrated rates and required projections based on a 25-year look-back period of the index, such as the S&P 500, with capped crediting rates. The goal was to stop insurers from using arbitrary or exaggerated returns. In 2020, AG 49A followed when insurers found ways around AG 49, often using multipliers and bonuses to make policies look more profitable. AG 49A required these features to be illustrated using the same capped rates as policies without them, aiming to close the loopholes that allowed insurers to show unrealistic performance. AG 49B was introduced last year in 2023. It was the latest attempt to address the issue, further restricting multipliers and bonuses to ensure illustrations reflected more realistic outcomes. This update focused on making sure enhanced products couldn't appear better than basic IUL designs without enhancements. Despite these efforts, insurers continue to find ways to navigate around these regulations. For instance, earlier this year, a Washington couple sued Pacific Life over misleading illustrations, claiming that the policy's performance was overstated and that the risks were not fully disclosed. In another case, a retiree in Idaho was awarded over $1.5 million in economic losses suffered from a failed retirement strategy involving an IUL. These cases highlight a fundamental problem. Many people are being misled by illustrations that show best case scenarios without a clear picture of the real risks. This brings us to risk number 2, the historical hypothetical look-back method and unrealistic illustrations. The historical hypothetical look-back method was introduced in NAIC's 2015 AG 49, and it was introduced to limit the aggressive illustrations which were based on short-term or overly simplistic performance data. It required using a 20 to 30-year look-back period to calculate the crediting rate on IULs. The reason why this method is unreliable is because of three things. Number one, it doesn't consider changing economic times. You've heard it before, past performance doesn't predict future results. Markets are volatile and unpredictable, and future market conditions may not mirror the patterns in historical data. Think about why, in a matter of 30 years, insurance companies went from universal life to variable universal life to index universal life. It was all because of the market and economic conditions. Bad economic conditions in the 70s led to the creation of universal life. Good economic conditions in the 80s led to the creation of variable universal life. And bad economic conditions in the 90s led to the creation of IULs in 1997. The number two reason why this method is unreliable is because policy charges have an effect on returns. Administrative fees, mortality charges, and premium costs are often not fully accounted for in these illustrations. These fees reduce the policy's cash value growth over time, and historical lookbacks do not consider how these ongoing costs impact overall returns. The third reason why the historical lookback method is unreliable is because it's overly optimistic. Insurers use these numbers to show best case scenarios, which may give policyholders overly optimistic expectations. Let's look at an example. First, let's look at how proprietary indexes are illustrated. A proprietary index is an index that was created specifically for the insurer in partnership with an outside financial institution. In this case, we'll look at the US Pacesetter point-to-point no-cap index offered by National Life Group. It's no cap, so there's no limit to the upside potential. The participation rate is 235%. So if there's a 10% gain in this index, the policyholder will have a 23.5% credit to their cash value. The guaranteed participation rate is 50%. So if the insurer does decide to bring down the participation rate to the guarantee level, the same 10% gain in the index will only credit 5% to the cash value of the policy. And the maximum illustrated rate is 6.44%. Now, before we go to the hypothetical, we read the illustration disclosure, which states the following. The historical performance of the S&P 500 index, Balanced Trend Index, and US Pacesetter Index should not be considered a representation of past or future performance of any of the index strategies available in this policy, nor is it an estimate of the returns that a policyholder can expect based on the current cap and participation rates. The future rate credited for any of these strategies may be less than or greater than the non-guaranteed assumed interest rates used in this illustration. Now, looking at the historical look back, you'll notice that it goes back 20 years from 2023 to 2004. The first column shows the growth rate of the actual index, including the 5, 10, 15, and 20-year average return. The second column shows the credit to the policyholder account with the 235% participation rate. Anyone who looks at these hypotheticals will think that this is a no-brainer to choose this index. Why wouldn't you? Your cash value will be credited 235% above the index's return. But let's go to the Pacesetter website like we are instructed to do on the illustration disclosure. Let's read the disclaimer about the index. The US Pacesetter Index was launched on December 10th, 2021, and any performance prior to such date is hypothetical. In other words, the illustrated returns from 2020 back to 2004 are not even real returns. They're just made up. The disclaimer says results during these periods may have been different, perhaps considerably, had the strategy actually been in existence. And this is not a one-off. This is a common practice with all proprietary indexes. The 1-year Choice Plus NYSE Zebra Edge Index offered by Nationwide has a similar disclaimer. The NICE Zebra Edge Index was established on 10/11/2016, but the historical hypothetical lookback goes back to 2002. That's 14 years of made-up returns. Now let's look at non-proprietary indexes. In this case, let's use the S&P point-to-point cap focus with National Life Group. First, we have a 9.25% cap rate. There's a 3.10% guaranteed cap rate, 105% participation rate, 100% guaranteed participation rate, a 6% maximum illustrated rate, and an additional 0.35% bonus starting in year 6, which is not guaranteed. So we know that the S&P has been around for more than 30 years, so there's no concern with looking back 20 to 30 years for historical returns. The issue is with the overly optimistic illustration and the perception that illustrations equate to conservative returns. Agents will say since the illustration will show 6%, but the cap rate is 9.25%, and the average returns over the last 20 years is over 6%, then your account will actually perform better than what's illustrated. The problem is that the illustrations assume 3 things. First, that the client will consistently overfund their account every single year. 2, that every single year has a positive return. And 3, that the insurer will never adjust the crediting rating. This illustration shows a 40-year-old male putting $15,600 a year into a policy until age 68. So there cannot be a single year that they pay less than what they say they will pay. Also notice the 6% yearly growth is consistent for the entire life of the policy, all the way until year 80 when the client turns 120. This is not only very optimistic, but it's very unrealistic. There's no way that you're always going to get a positive year out of the market. Any client that looks at this illustration without any proper explanation of what they're seeing will believe that their account will grow 6% per year every single year, which is never the case. Just compare that to the 20-year look back in the hypothetical return strategy, and you'll notice that 7 out of the last 20 years saw a less than 6% gain. It means that a little over 30% of the time, you'll experience years with interest rates less than expected. I'm not saying that this is going to happen exactly 30% of the time, but the reality is that the hypothetical itself shows you why you shouldn't assume positive returns every year for 80 years. This gives you insight into why you can't rely on these illustrations to plan properly for loans or income, which most of these policies are purchased for. Overall, the historical hypothetical look back method might seem like a way to keep projections realistic, but it often leads to inflated expectations by relying on past data that doesn't reflect future uncertainties or hidden costs. This approach can leave policyholders with an overly optimistic view of their potential returns and a false sense of security. The historical hypothetical look back method also does not consider the intricate details that go into IUL policies, which brings us to risk number 3, the complicated and unpredictable indexing strategy. Let's look at the basic workflow of an IUL policy. Let's assume a $1,000 premium. You pay $1,000 into your policy. A portion pays for the cost of insurance. Let's say that's $100. The remaining balance of 900 goes into your cash value. The insurance company invests that 900 into their general account where they hold conservative investments. The general account is how the insurance company can cover guarantees, such as the guaranteed floor or the minimum return and the guaranteed death benefit. The insurer allocates a portion of the investment returns from their general account into their options budget. The budget is sent to an investment bank who use the options budget to purchase financial options that provide the index-linked growth to your cash value. Options such as the S&P 500, for example. Now, depending on the index's performance, your cash value will be credited at the end of the crediting period, whether it's every month, once a year, or every 2 years, depending on the company and the index that the client chose. This is a very basic understanding of how money flows into and through an IUL policy. Now let's talk about why this isn't as straightforward as it sounds. There are many moving parts that can impact how much your cash value actually grows. For example, the options budget alone is a big factor in policy performance. And there are several factors affecting the options budget. They can be internal, like policy fees, or external factors like market conditions. Let's look at some internal factors that will affect the options budget. First is policy charges. Policy charges, including the cost of insurance, administrative fees, mortality charges, and rider fees. These fees affect how much of the remaining premium is allocated into the insurance company's general account, which in turn affects the general account's performance and the amount available to allocate towards the options budget. Another internal factor that affects the options budget is the interest rate earned in the general account. The general account typically holds investments such as bonds, mortgages, mortgage backed securities, income producing real estate, private debt, fixed income securities, cash, and short term investments, and maybe some international investments as well. The returns from the conservative investments in the general account are used by the insurer to fund the options budget. In a high interest rate environment, the insurer can allocate more funds to buy options, potentially increasing the credited interest for the policyholder. In a low interest rate environment, the options budget shrinks, leading to lower returns. Now, a third internal factor that affects the options budget are cap rates, participation rates, and spread charges. Cap rates limit the maximum return credited to the policyholder. Participation rates determine how much of the index's performance is credited to the policyholder. These features allow the insurer to control costs to ensure that they don't exceed the options budget. The spread between the returns generated in the general account and the interest credited to the policyholder also affect how much can be credited towards the options budget. So those are the internal factors. Let's look at some external factors that affect the options budget. First, you have market volatility. Volatility in the stock market impacts the cost of options. When there's high volatility, options become more expensive, forcing insurers to spend more of the options budget for the same market exposure. When there's low volatility, options are less expensive, allowing insurers to buy more exposure for the same budget. A second external factor are the bond yields. Some insurers primarily invest in bonds. When bond yields are high, more money can be allocated to the options budget. Low bond yields reduce the available funds for options. Third is the options pricing model. The cost of options is determined by sophisticated pricing models like the Black-Scholes model, which takes into account several variables such as the underlying asset price, volatility, time to expiration, and interest rates. If any of these variables changes, the price of options fluctuates, affecting how much the insurer can allocate to the options budget. Finally, are the hedging costs. Insurance companies use hedging strategies to manage the risks associated with offering market linked growth. The cost of hedging against risk can increase if the market is volatile. This reduces the portion of the options budget available for actual market participation. Hedging is necessary to ensure that the insurance company can meet its obligations even during tough market conditions, but they increase the overall cost of managing the options budget. So, with so many things affecting how your IUL grows, it's tough to actually predict what your policy will look like 10, 20, or even 30 years down the road. This makes it hard for agents to give you a clear picture of your future returns. And that's why understanding these moving parts is so important before you buy an IUL. When you get an IUL policy, you'll also see a lot of numbers and terms in the illustration. Let's break down these different parts of the illustration. First, you have the index interest strategy themselves. These are the different indexes that the insurance company will have the right to buy through the call options that they purchase. Choosing the right index is a factor in how your policy performs. Not just the type of index, but also the crediting schedule. For example, the 1-year capped S&P 500 tells you that the index is the S&P 500, the interest you earn is capped, and the interest is credited every year. Some indexes are credited every 2 years, such is the case with the 2-year JP Morgan Mosaic 2. There's also the proprietary indexes that insurance companies offer. Again, a proprietary index is a custom or synthetic index that's designed by the insurer in partnership with an investment bank or financial firms. They do this to try and offer an alternative to standard index funds, but these funds are not even real in the public sense. As we saw earlier, they aren't traded or accessible in the public markets, and the insurance company uses complex algorithms and volatility controls designed to protect them from having to credit too much interest during strong market performance, limiting the upside for policyholders. Another item in an illustration is the floor rate. This is the minimum interest rate that will be credited to the account if the index performs in the negative. Some agents will tell you that you never lose money in an IUL. However, if the market experiences negative returns and you get credited 0% towards your cash value, you still have to pay policy fees, which will be taken from your cash value or your premium. Then you have the cap rate. This is the maximum interest rate that will be credited to the account. Notice that the guaranteed rate is 4%, which means that the insurance company can reduce this rate to 4% whenever they need to. Now, that doesn't mean that they will, but it means that they can. Something to keep in mind also is that cap rates over the last 20 years have reduced significantly. Between 2005 and 2007, cap rates were around 16%. Between 2008 and 2012, they were around 14 to 15%. From 2013 to 2019, they fell between 10 and 12%. And from 2020 until today, they're around 8 to 10%. Now, these cap rates are illustrated for new business. What I mean by new business is that insurance companies can attract new clients by illustrating and promoting these high cap rates and high performance illustrations. But clients who bought policies in earlier years, who may have had their cap rates reduced, may not participate in those high interest rates that are being promoted. For example, if someone purchased a policy in 2007 with an illustrated cap rate of 16%, meaning that they saw an illustration and it said that they're going to gain 16% for the rest of their life, and they had their cap rate reduced to 8% by 2017, 10 years into their policy, their neighbor who purchased a policy in 2017 may have an introductory cap rate of 10 to 12%. That means that the new business that's written in 2017 will have a cap rate of 10 to 12%, but anyone who already owns a policy will have a cap rate of 8%. So the people who purchased these policies in previous years are not receiving the interest that is being promoted by the insurance company. Another item that you notice is the participation rate. This is how much you're participating in the interest returned by the index. For example, if there's a 9% return, then you will be participating in 100% of the 9%. If the participation rate is higher, let's say 150%, then you get 150% of the return up to the cap rate. There's also the spread rate. So this usually applies only to uncapped indexes and is almost like a fee. For example, if the index returns 15% and you have a 10% spread rate, then you will only be credited 5%. You're participating in anything that is over 10%. There's also the charge rate, which is a yearly interest rate that you're charged and usually applies to uncapped indexes. You'll be charged whether your index performs in the positive or in the negative. You also have the maximum permitted illustrated rate, which is very self-explanatory. This is the maximum allowable interest rate that can be shown on an illustration. You also have the illustrated rate, which is the rate that is illustrated on the illustration. And you have the historical average, which is the average return of the index for the last 20 to 30 years, depending on the company. Index universal life insurance might seem like a solid financial tool, but its performance depends on many unpredictable factors, such as we saw. You have cap rates, participation rates, you have fees, and the regular market conditions. Even small changes can dramatically affect your cash value. While you're protected from direct market losses, your cash value can still decrease due to rising costs and policy fees. This leads us to IUL risk number 4. Cash value can be lost, rendering IULs impermanent. The phrase "you can't lose money due to market loss" is only a half truth. You can't lose money due to market loss because your money is technically not in the market, but you can lose money because of market loss, especially when the cost of insurance increases every year. Let's see how these insurance policy charges are a huge factor in reducing cash value. So, policy charges are the sum of all expenses and deductions taken out of the policy, including premium expense charges, cost of insurance, cost of other benefits such as riders, policy fees, expense charges, and accumulated value charges. So, how is the cost of insurance calculated? The first variable is the net amount at risk, the NAR, the portion of the death benefit that the insurance is at risk of paying out in the event of the insured's death. The NAR is the difference between the accumulated cash value and the death benefit. If you compare two accounts with the same exact death benefit, the account with the smaller cash value has more NAR than the account with the larger cash value, which reduces the net amount at risk. The cost of insurance equates to the NAR multiplied by the cost of insurance rate. The cost of insurance rate is the rate that the insurance company charges for every $1,000 of net amount at risk. This rate depends on factors such as the insured's age, their gender, their health classification, and their underwriting class. All index universal life insurance contracts have an annual renewable term or an ART like structure built in to manage the cost of insurance. This means that every year on the policy anniversary, the cost of insurance is assessed based on the age and risk of the insured. As you age, the cost of insurance goes up and it increases exponentially. And with it, the total policy charges increase as well. Let's look at an example. This is the policy charges and expense table for the earlier illustration. We can see the different charges and fees of the policy. You have the premium expense charge, the cost of insurance, the cost of other benefits, which are the riders. You have the policy fee, the expense charge, the accumulated value charge, and finally the policy charges, which is the total of all charges. Notice that in the first year, the cost of insurance is only $75. As the client ages, the cost of insurance increases and peaks at a total of $19,843. That's a difference of $19,768 or a 26,350% increase in cost. The total policy charges in year one is $2,247, and that increases by $17,688 to $19,915. That's a 786% increase. This is typical of all IUL policies, whether it's properly or improperly structured. The cost of insurance will increase exponentially. These expenses are deducted monthly from the cash value. If the policy's earnings are too low to cover these costs, the cash value will decrease. And because most agents are not familiar with how to properly structure an IUL, many policies will lapse simply because the policy owner was unaware of the rising cost of insurance. There are other factors that can lead to losing cash value and the policy lapsing. Prolonged poor market performance is one. So although IUL policies have a 0% floor, there is still a risk if the market underperforms for a long period of time. If the policy earns 0% for several years in a row, while policy charges are still being deducted, the cash value will decrease. This is particularly risky during prolonged periods of low market returns or if the index strategies chosen consistently underperform. The likelihood of consecutive years of no growth is very rare, but it's possible, especially during extended bear markets or periods of economic stagnation. The actual return of the market plays a small role in the performance of an IUL. Underfunding the policy is a bigger factor. One of the selling points of IULs is the flexible premiums. However, if your policy is set up so that you're paying close to the maximum in allowable premium, and your financial strategy depends on you continuously paying that specified amount, then you really don't have any flexibility with your policy. If the policyholder only pays the minimum premium or less than the target premium, the cash value may not grow as expected. The accumulated cash value may not be enough to cover increasing costs over time, especially as the policyholder ages. There are a couple of statutory premiums that a policyholder can pay. You have the target premium, which is designed to cover the basic cost of the policy, but is not optimized for cash value growth. According to this illustration, if the client decided to only pay the target premium of $4,256.30, the policy would lapse in year 38 when the policyholder is 79 years old. This means that there's no cash value and there's no death benefit. You also have the death benefit protection premium, or what's called the monthly guarantee premium. Now, this works in conjunction with a death benefit protection rider, and it states that as long as you pay this amount, even if the cash surrender value is less than or equal to zero, it will keep the policy from lapsing until the end of year 20. There is zero cash value growth, and the monthly guarantee premium for this policy is $2,071.92. You also have the minimum premium, or the MMP. This is the lowest amount of premium required to keep the policy in force for a certain amount of time. This premium is primarily used to cover some expenses, but the cash value will be depleted much more quickly than the target premium. And the MMP for this policy is $1,550.40. You also have the guideline level premium. This is the maximum allowable premium that can be paid before the policy will be considered a modified endowment contract. In other words, you can't pay more than this premium if you want to keep the tax savings of your policy in place. And this can be used as a catch up payment as well. The guideline level premium for this policy is $15,922. An IUL must be funded in such a way that you create enough cash value in the early years that the cost of insurance is covered by the interest credited to the account. Therefore, you cannot underfund your policy, especially in those early years, no matter how much the agent says that you can. If you do, then you have to make catch up contributions, which are limited by the guideline level premium, and you lose an opportunity cost as the compounding effect was subject to a smaller amount of premium than you contributed. The cost of insurance will eat up the policy and it will lapse in later years when you actually were planning to use your plan as a retirement subsidy or to take out loans. Another factor that can cause your policy to lapse are the loans and the withdrawals. So, loans taken out of an IUL are either participating or non participating. When the loan is non participating, the cash value is directly reduced because the borrowed amount is removed from the index account. It is no longer participating in the index. A participating loan is when the borrowed amount remains in the index account and continues to participate in earning interest. Another selling point of IUL agents is that clients can borrow money from their policy and never have to pay it back because if the insured dies with outstanding loans and interest, the insurer will just use the death benefit to cover those costs. This is especially the case when a policy is sold as a future source of income for retirement. The risk with taking loans from an IUL, especially for retirement income purposes, is that the insurer charges interest on the loan amount, and if loan interest is not paid, it is added to the loan balance, which increases over time due to compounding. This can reduce the amount of cash value that is free for future borrowing or for covering the cost of insurance and other fees, particularly if the index performs poorly or earns a low return. In years when the index underperforms or hits a 0% floor, the loan interest could exceed the growth of the cash value, which eventually depletes the available cash value. Over time, if loan interest continues to accumulate, the death benefit can also be significantly reduced, or the policy may lapse if the cash value is depleted. In this illustration, the client is planning on utilizing $84,122 in borrowed funds as retirement income starting at age 70. The loan rate is 5.5%. In year 30, when the income starts, he only has to borrow $84,122. In the second year of retirement, he needs to borrow $86,607 to cover his income and the cost of insurance. As the years progress, the client needs to continue withdrawing more and more than the previous year to cover the income plus the compounding interest. Since this is a participating loan, the cash value will continue to grow at the illustrated 6% interest rate, but we have to use logic and reasoning to understand why this is not going to work as expected. Number one, the loan amount is based on the accumulated cash value, which again assumes the client will continuously maximize their account for 30 years and assumes a positive 6% return for the same amount of time. Two, the interest on the loan is assumed to stay at 5.5%, but the insurer can adjust it up to 8% at their discretion. So if your cash value is growing at 6, but the interest on your loan is 8%, then you're already losing 2% in interest by just taking out loans from your policy. Thirdly, although the premium is no longer being paid, policy charges are still due on the account. So not only are you paying the policy charges, but you're also having to pay the interest on the loans that you took out. Loans and withdrawals from the cash value of an IUL are generally tax-free as long as the policy remains in force and is not considered a modified endowment contract. This is because loans are not considered taxable income, and withdrawals are typically tax-free up to the cost basis or the amount of premiums paid into the policy. However, taking excessive loans from the policy without properly managing the cash value can lead to a situation where the cost of insurance grows faster than the cash value, depleting the policy and triggering a lapse. When the policy lapses, the loan balance is treated as taxable phantom income, leaving the policyholder with an unexpected tax bill. This leads me to risk number 5: improperly structured policies and agent compensation. A properly structured IUL focuses on maximizing cash value growth while keeping costs and policy fees under control. This involves a couple of factors, including overfunding the policy, managing loans carefully, selecting the right death benefit options, avoiding a mech, and choosing a reputable insurance company. Regular policy reviews and strategic use of riders are also essential to ensure that the policy remains sustainable and beneficial over the long term. Key elements that define a well structured IUL are the following: 1. Maximizing the cash value growth. Overfunding involves paying more than the target premium and less than the guideline level premium. When the policy is overfunded, the net amount at risk decreases, which allows the cost of insurance to be covered, while a larger portion of the premium goes towards cash value. 2 is avoiding a modified endowment contract, which will remove the tax advantages of a life insurance policy. A properly structured IUL should be overfunded while also avoiding becoming a modified endowment contract. If the policy is overfunded beyond the IRS limits, it could become a mech, which changes the tax treatment of the policy. Loans and withdrawals from a mech are taxed as ordinary income. Third, selecting the right death benefit option. IUL policies have two types of death benefits. First, you have option A, or level death benefit. This is when the death benefit stays the same, and as the cash value grows, the net amount at risk decreases, which reduces the cost of insurance. This is ideal for those looking to maximize cash value growth. The second option, or option B, is the increasing death benefit. The death benefit increases as the cash value grows. This option might be better for those looking for higher death benefit protection, but it generally comes with a higher cost of insurance and is less effective at growing cash value. A properly structured IUL often starts with option B, an increasing death benefit in the early years to provide more coverage, but then switches to option A as the cash value grows. This reduces the cost of insurance in later years and accelerates cash value growth. 4 is the balancing of loans and withdrawals. One of the major benefits of an IUL is the ability to take tax-free loans against the policy's cash value. A well-structured IUL ensures that loans are managed carefully to prevent the policy from lapsing due to excessive loan balances. The policyholder should monitor the cash value closely and ensure that there's enough growth to cover both the loan interest and the rising cost of insurance. By taking loans strategically, the policyholder can access the cash value for retirement income, investment, or other needs without depleting the policy. 5 is minimizing fees and expenses. A well structured IUL minimizes the impact of fees and expenses. This includes managing costs of insurance, policy fees, and surrender charges. By carefully reviewing these charges and selecting the right policy features, the policyholder can maximize the cash value growth and avoid unnecessary expenses. The sixth factor is choosing a reputable insurance company. A well structured IUL is only as strong as the insurance company that backs it. It's important to choose a reputable, financially stable insurer with a good track record in offering competitive cap rates, participation rates, and index strategy options. Finally, is regularly reviewing the policy. A properly structured IUL isn't a set and forget. It requires ongoing management to ensure that the policy continues to perform as expected. Regular reviews allow for adjustments in premium payments, index strategy allocations, and death benefit options. Getting in-force illustrations every few years helps evaluate how the policy is performing compared to initial projections, ensuring that the policyholder stays on track. There isn't an exact public statistic on the percentage of all IUL policies that are properly structured. Some may say it's because clients are not informed about how policies work, or that the policies are not being reviewed or managed over the life of the policy. But I believe the biggest reason is because the majority of agents are focused on commissions rather than the best interest of the client. Whether it's due to malice or ignorance, the needs of the client are sacrificed for the sake of a higher commission. For the sake of understanding how agents are compensated, let's focus on three factors: the target premium, the guideline level premium, and the death benefit amount. The target premium is directly tied to the death benefit because it's designed to cover the cost of providing that benefit over the life of the policy. Agents earn commissions based on the target premium and not on the total premium paid. As a result, there is less incentive for agents to design a policy with maximum cash value growth by encouraging clients to put more of their budget towards paying only the target premium. For example, let's say a client wants to maximize the cash value in an insurance policy and has little concern for the death benefit. This client has a strict budget of $1,000 per month. Here we have Agent A, who is very commission minded. Agent A creates a policy with a death benefit of $500,000, a target premium of $1,000, and a guideline level premium of $5,000. If the client pays their premium into this policy, their $1,000 will mostly go towards the cost of insurance, with very little, if any, going towards the cash value. This is not a max funded policy. What this will do for the agent, however, is pay them a commission based on the target premium of $1,000. This is great for the agent, but not good for the client. On the other hand, we have Agent B, who is focused on the needs of the client. Agent B creates a policy with a death benefit of only $150,000. The target premium is $200 and a guideline level premium of $1,000. If the client pays their premium into this policy, their $1,000 will cover the cost of insurance, which is only $200, and the majority will go towards their cash value. This is a max funded policy. The agent in this case will lose out on commission since the commission will be structured around the $200 target premium. Since this agent is focused on actually helping clients, this type of policy is great for the agent and great for the client. Setting up a properly structured IUL often reduces an agent's commission, creating a financial incentive to prioritize their own earnings over the client's best interest. Recruiters and agency leaders push agents to maximize commissions quickly, fearing high turnover rates, which leads to policies being sold for short-term profit rather than long-term value for clients. On top of that, agents are usually trained to sell IULs to everyone without considering whether these policies actually fit the client's needs. This one-size-fits-all approach stems from a rigid mindset in the industry where agents often align themselves strictly with one type of policy, whether it's term, IUL, or whole life, without understanding how different products can benefit different clients. To make matters worse, 95% of life insurance agents leave the industry within 5 years. This means most agents won't be around to help clients navigate policy changes or address issues that arise down the road, leaving many policyholders without proper support when they need it the most. So, in closing, index universal life policies are often marketed as the ultimate financial tool, offering flexibility, tax advantages, and the promise of market linked growth with downside protection. But as we've uncovered today, the reality is far more complex. Hidden fees, increasing costs, and the ever changing rules governing these products can put your hard earned money at risk. If you're an agent committed to integrity, and want to learn how to structure policies in a way that truly benefits our clients, I would love to connect with you. If you're considering using life insurance to build wealth, let's create a customized illustration and review your financial plan to see if this strategy aligns with your goals and values. If you already own an IUL, let's review your policy together. We'll break down your illustration, uncover any potential risks, and see if your policy is truly performing as you expected. Make sure to like, share, and subscribe for more insights on building wealth with integrity and avoiding financial pitfalls. And don't forget to leave a comment or reach out to me directly if you have any questions or need further clarification on anything that was discussed in this video today. And remember, money is your servant. Master it.